Today, we're going to take a closer look at a lot of AI news, a lot of semiconductor companies. We're going to look at companies like TSMC, which just reported their monthly numbers. Synopsys, the stock is down roughly 29% in the past 5 days after earnings weren't the greatest. We're also going to take a closer look at Nvidia and some recent news impacting OpenAI and Microsoft. This is going to be filled with a lot of information. So if you are an investor in the semiconductor space, in the AI space, in the tech market, you're not going to want to miss this out. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so first, let's start off with TSMC. TSMC, for those that are not familiar, is the manufacturer of almost all the AI chips that we have right now, right? Nvidia, AMD, and all these big players go to TSMC to manufacture the chips. Year to date, TSM has been doing pretty well, 28.65%. Now, the company, because it is an international, they do share kind of monthly revenue numbers. And on September 10th, TSM reported their August 2025 numbers. And just from, we're going to look at some charts, but just quickly, we can see revenue on the month over month was up 4%. On the year over year, it was up 33% versus August of 2024. And if we look at January to August, so year to date for both this year and for last year, the overall revenue is up about 37.1%. Now we're already more than halfway through the year. And TSMC has reported that on the dollar base, US dollar base, revenue growth was going to be up north of 20% on a year over year basis. We can see as numbers are continuing to move at this direction, it looks like it's going to be closer to a 30% year over year growth basis, which I think is pretty damn good. Now, I have some pretty cool charts that I want to show here with TSMC, and this is where you're going to get a lot of information in this channel, right? We don't just look at the headlines, we deep dive, we dive into it and learn a little bit more and kind of look at it in different directions. So first, this is their revenue since March of 2026. Overall, company's monthly revenue continues to go up dramatically. Pretty strong. Obviously, there have been some peak months for TSM, but I don't think that's anything to be concerned of. Overall, the trend for this revenue continues to go up. Now, I also wanted to kind of look at just August revenue comparison compared to other years. And again, we can see August revenue is the highest, marginally higher. Obviously, 33%, over 30% year-to-date growth, year-over-year growth compared to last year. But I think these visuals really kind of show the massive growth of this company right now. The other thing I wanted to kind of look at just the year-to-date revenue comparison, and not only to obviously show, we already know, we looked at those numbers, it was up a nice amount year to date versus last year, but I also want to show historical value so we can just continue to see this massive demand for semiconductor products. And this is, for me, why I'm super excited about the semiconductor industry. We continue to see growth, even though there could be cyclicality here and there, right? We can see in 2023, there was a bit of a decrease compared to 2022, or how certain cycles you barely saw any growth. Here in 2018 and 2019, you barely saw much growth in the semiconductor industry. But as tech continues to innovate, as tech continues to grow, in the world where we're going to be with robots, with autonomous driving, with crazy drones, with crazy taxi helicopters, with in AI solutions in everything, with glasses, augmented reality glasses or virtual reality glasses, the demand for chips are going to continue to grow. And I do believe we're going to continue to see an uptrend here. The other thing I wanted to kind of show, I really like this. So this is since like 2006, the average contribution to annual revenue by month. And most of the months are going to be around 7%. Usually at the beginning of the year, you can see January 7%, February 6%, March about 7.5%, April about 7.5%, May about 8%, June about 8%, July about 8.4%. August tends to be a nice month of about 9% of revenue for the year, based on those values that we saw before. But the most important thing is from here on out, September is another 9%. October is sometimes even closer to 10%, and November 9%, and then December about 8.6%. So historically, what I'm trying to say is the biggest revenue growth, or yeah, the biggest revenues for TSMC are usually August, September, October, and November. And we're only in the first month of this year, and we're only in the first part of it, August, and it was already up about 30+% on a year-over-year growth basis. It gets me pretty excited for the rest of the year here for semiconductor companies. So that's overall TSM. I think it was just a bullish indication that we are in this healthy trend in the AI market, even though especially since the consumer market is still somewhat weak. So imagine the massive amount of demand that we can get when the consumer market picks up, when we need more PCs, when we need more laptops, when we do have things like autonomous robotics, autonomous vehicles, robotics, AR glasses and VR glasses, and all those other products that I discussed earlier on. Now, the next company I want to take a closer look at is Synopsys, ticker SNPS. Now, for those that are not familiar, Synopsys is a company that provides software solutions to design chips and other type of electronical circuits. The stock is down roughly 29% in the past 5 days. From its overall bottom, it kind of saw around $390, $386 here. With aftermarket, after hour prices, the stock is up nearly 10% from the bottom. I personally am looking at this stock and I see the opportunity. So we'll look at why the stock dropped. But from its overall 52-week high, the stock is down roughly 34%. So more than a third of this company's valuation lost after earnings. Now, I'm going to look here at some great charts, and these great charts are all possible thanks to fiscal.ai. If you want 15% off this fiscal.ai/Jose, check out the link or what I just said there. This is a platform I use on a daily basis. It helps me with my investing. If you are serious about long-term investing, you need this. You definitely need this. There's a lot of great data, a lot of great charts, and a lot of great things. I use it every single day, and it's not that crazy expensive. Now, first, what I'm looking at is total revenues in the last 12 months. And we the first thing that you might notice is while it is in a nice uptrend, there isn't any crazy growth. It's a nice uptrend going here, $6.4 billion in the last 12 months. Now, there are two segments that Synopsys kind of really works in. The first one is the design and automation revenue, and that's where most of this growth is coming from. This is the software that helps with the design process. And you see kind of a nice growth. Might have been there has been some flat line this year in like the months of April, January, and October. And remember, this is last 12 months. Unfortunately, their second revenue, which is this purple, is design IP revenue. So they kind of create some form of things, I wouldn't say finished goods, but obviously with IP, you create something, you design something, and then you can sell it, lease it out, get some fee from it. And that's this design IP revenue. This market has seen no growth pretty much, I would say, since April 24th. April 24th, on the last 12-month basis, it was about 1.8 billion. We can see right now it's sitting at 1.9, almost a year and a quarter later. No growth here. And this is what's creating a lot of fear for Synopsys. Now, I'm going to look actually at their PE ratio last. Here in fiscal.ai, we can also look at the earnings transcript. And I wanted to look at the earnings transcript of Q3, which they just reported on September 9th, and AI quick summary. So we can just see what are some of the things impacting. The biggest thing is their design IP revenue was down 8% year over year. The main reason is this company expects lower revenue in this segment. Now, I'll talk a little bit about those lower revenue, but they did have to reduce their guidance. They reduced their guidance for the full year, for this fiscal year, because of some of the hiccups that they have. Now, because of that, the market obviously punished the stock. Now, I wanted to provide a little bit of the reason why it's having that hiccup in the IP side. And there's two main reasons. The first reason is the China market. So within the China market, I'm not sure if some of you are familiar, there for about 6 weeks, certain products were unable to be sent, or they were unable to do certain deals in China because it was restricted by the US government. It was later eased. It only lasted 6 weeks, but the company mentions that the overall pain that a customer saw is lasting more than 6 weeks. And the main reason is designing chips or anything is usually a multi-year thing. If I was a Chinese customer, why would I want to go with Synopsys? And then maybe a few months later, the US government says you can't send anything else to China. You can't use your software solutions over there. You can't share your IP over there. Those customers that were working on your platform that takes multiple years to design something, now they have a question. What happens if I'm designing midway and the US government just cuts it off completely? I don't want to risk it because I'm going to risk engineering time. I'm going to risk research and development. And if my competitors are using something else that doesn't get targeted by the US government, they're going to end up beating me. So I understand that portion and it does make sense. The second thing that they mention is with the IP, they were made a nice amount of investments in Intel, and Intel was supposed to have 18A. So they created a lot of IP for that foundry customer. And in their guidance, they were expecting revenue to see in the second half, both for internal and external customers for Intel 18A. And they had kind of baked that into their guidance. Unfortunately, it seems Intel is not doing as hot as Synopsys was expecting. And for that reason, they don't want to put that in their guidance anymore. They don't see that money coming in by this year. And just a quick thing, they just reported their third quarter. So the quarter that they're about to be would be the final quarter for their fiscal year. So they don't expect that to come in, and they took that out of the guidance as well. So they took out a lot of China market, and they took a lot of from this external customer, the foundry player, because Intel isn't really seeing much return out of 18A. So they're taking that out of the guidance, and that's the main reason the stock so that revenue guidance drops, which created that massive fear for investors. The final thing is the company also mentioned that fiscal year of 2026 is expected to be a transitional period for their IP business. And you really won't see much until fiscal year of 2027. And again, just to kind of remind investors that their quarter three was for fiscal year of 2025 still. So for next year, pretty much maybe the next 16 months, they believe there's going to be a transitional phase for their IP business. And until then, after those 16 months, they might start to see some regrowth in the IP business after they kind of see a lot of these things push back up. So that is creating a lot of fear here for Synopsys. Now, I'm going to say the stock right now on a forward PE ratio is trading at roughly 33.7. And then we're going to look at the charts really quick, but I wanted to pull up the toggle median. The median right now is about 30.89. So this is actually going from January 16th. If we kind of maybe even go closer to where this company has transformed a little bit, let's just start from October 2019. The median is actually 36.67. And right now, the stock is actually trading very cheap. And I'm actually even including certain time frames where the forward PE ratio is usually in the 25s. So I think this is a fair time frame, creating both some bullish and some bearish sentiments. And right now, this stock is trading at a cheaper valuation than it historically is. Now, remember, forward PE ratios are usually based on analyst expectations. The company just reported earnings. So in the upcoming days, we might see analysts reducing revenue guidance, reducing certain earnings projection, and we might see the forward PE maybe increase a little bit and get closer to the median. Regardless, in my opinion, I don't think what Synopsys reported during the earnings is a business ender or is going to destroy the business or it's going to be a massive lagger in the long term of things. I think this could be a buying opportunity. I don't have Synopsys in my portfolio. I'm still debating it, but I think in the long term, Synopsys will have some great returns, and these definitely seem like some great price returns for long term because Synopsys is definitely a big player in this space. So that's what I have to share there for Nvidia. For Synopsys, would love to hear your thoughts below. Next, I want to jump into Nvidia. So I've done a few videos on Nvidia in the past. Obviously, I cover Nvidia pretty drastically through this channel, but there's a lot of information that just came in. I want to say in just the last 48 or so hours. The first thing is we see reports that NVIDIA's AI server faces unimaginable demand amid Blackwell Ultra GB300 ramp up as key suppliers. Quanta reports production bottlenecks. So for those that are not familiar, NVIDIA is now releasing the GB300, right? The Blackwell Ultra solution. And it seems demand continues to grow dramatically. This is the first kind of topic that discusses that. Then we kind of see here, for a non-financial analyst here, Dan, shows a quick image server OEM monthly revenue. Here we can see 2025, much, much higher than 2024, 2020, even anything, right? So the demand for AI chips, AI servers continue to grow. I do believe a good portion of that is NVIDIA's solution. Now, there were some interesting thoughts or rumors. I haven't seen anything to back this up, but we see another semiconductor analyst report that NVIDIA is requesting TSMC to move up the Rubin platform schedule. NVIDIA, I guess, has everything in the supply chain pretty intact, and they want to continue to have the lead in the market, right? They don't want to have competitions have any form of even thought process that they can match NVIDIA. So there's no reports, there's no confirmation on this. If this is true, I've seen two sides. The bearish side is NVIDIA is scared of AMD and they want to release the schedule ahead of time. I don't think NVIDIA is really scared of a specific company. I think NVIDIA is just always paranoid. But Jensen won't do something if it means doing it wrong. To my opinion, it means that NVIDIA is a little bit ahead of schedule. They seem to have worked, if they might have thought some supply chain issues would have arisen. So they gave themselves a longer timeline. They see that maybe everything's working better. So for that reason, they're like, hey, look, everything's working good. Why don't we just release the newer product? Because the AI market is just still seeing crazy, crazy demand. So we'd love to hear your thoughts if you think this is bullish or bearish. Again, I see this more of a bullish thing, but I've seen the bearish take as well. Now, there is another report that came out a lot for NVIDIA. NVIDIA steps back from DGX Cloud and stops trying to compete with AWS and Azure. DGX Cloud fades into internal use as NVIDIA positions Lepton to direct AI workloads across partner infrastructure. Now, for those that weren't familiar, during this kind of the beginning of this AI boom, NVIDIA, I guess, believe that a lot of their partners in the clouding space we're not adopting to AI infrastructure quickly enough. So NVIDIA started to partner up with these cloud players and kind of build kind of an AI infrastructure within them and then rent it out to customers. Again, I think this was just NVIDIA doing the blueprint of, look, this is why you need to do the AI infrastructure. You guys always talked about that. This is why you need to have this AI infrastructure. I'll show you. I make money out of it. I'm going to give you the blueprints. I'm even going to show you how to do it. And it seems it doesn't need to do that anymore, right? Everybody knows that you need to build AI infrastructure. Some people might see that as a bearish case, that maybe your cloud providers are pushing you off. I don't necessarily think that's true. I think it has to do more with Lepton. So NVIDIA's Lepton is kind of a newer solution to this. So NVIDIA has talked about it, that this is kind of like the Uber of AI infrastructure. You have, which is DGX Cloud Lepton. And then you have all these different partners, these different marketplaces. And if you have leftover infrastructure, you can just go to DGX Lepton and say, look, I need 1,000 AI GPUs of Blackwell. Does anybody have it? So it's the Uber, right? Instead of calling for a car, you're calling for AI infrastructure. And for this is kind of like the better version. It's like the transformation version of the DGX Cloud. It's like from going from Blockbuster to more of like a Netflix, if that makes sense. So I think it's the great direction, and I wouldn't see this as a bearish case either. Now, some more information I have here is there is someone presenting based on Merit Security Research Center, ASIC chip trends and outlook. We see for 2025, ASIC is mainly expected to be Google's TPU and AWS Trainium. In 2026, it's estimated to be, again, those two players with some Meta. Meta's finally going to be having their AI chip. I believe Meta is Broadcom, and then you have Microsoft with their Maya and OpenAI as well. And then you kind of, I would say anything at 2027, it's very hard to predict. 2025 estimates, I think, is easier to predict since we're already midway through the year. 2026 as well isn't that bad. The other thing that we have here is this pretty cool chart that kind of talks a little bit about who are some of the winners of ASIC. Here we can see, what can we see? So Broadcom wins a lot of the TPUs, obviously from Google, especially the performance size. The efficiency, which is like their V7E, V8E, is usually Google and MediaTek. In Meta, most of Meta is Broadcom. Their MTI V2 to MTI V4 seems to be mainly Broadcom. AWS, Trainium 2 is Marvell. Trainium 3 is AI chip. Trainium 3 Lite is Marvell. With Microsoft, you see some Microsoft with Gook. And then M400, which is going to be the one at the end of 2026, is going to be Microsoft and Marvell. So you definitely see some Marvell wins, which is pretty good. Obviously, Broadcom is the biggest player here. Now, the final thing I want to share here is I just did a memory episode. And this is some bearish news that's coming out. So again, no confirmation, but this analyst does share some information that tends to be right. And they mentioned that Micron is expected to focus more on server DRAM and NAND rather than HBM because their HBM4 is having some speed issues. Recently, it's reported that Nvidia increased the speed that it needed for HBM. And unfortunately, based on these reports, Micron might not be able to meet it quickly enough. So instead, shifting a little bit more to server DRAM and NAND. Now, we have earnings from Micron happening in less than 2 weeks. This is definitely going to be a topic of discussion. But obviously, if this is true and they mention some delays here with HBM4, it could create a massive sell-off to Micron. Again, I'm not saying it's true, but if you are a Micron shareholder, you're going to want to, this is something you're going to need to pay attention to and listen to during the earnings call. Do your research and just start searching any more of this. So that's pretty interesting. The final thing I want to take a closer look at is Microsoft made a joint statement with OpenAI that they have signed a non-binding memorandum of understanding for the next phase of their partnerships. They are actively working to finalize contractual terms in a definite agreement. Together, they remain focused on delivering the best AI tools for everyone, grounded in their shared commitment to safety. Because of this, it is reported that OpenAI is expected to reduce the revenue share with Microsoft, which in the long term of things, starting wherever it starts, it's going to be saving OpenAI about $50 billion from that revenue that it would have given to Microsoft. Now, there's a lot of here. Obviously, we're going to wait, but reportedly, it's reported that OpenAI has informed shareholders that it plans to slash Microsoft's revenue share from 20% to approximately 8% by 2030. Though under this new agreement, it does seem like Microsoft will obtain approximately 1/3 of the restructured OpenAI entity. Microsoft will also receive equity stake of over $100 billion in the nonprofit side. And yeah, so it's a give and take here. The main reason I think this might be somewhat important is we did see that deal with OpenAI and Oracle, right? So if you really are saving an extra $50 billion somehow, now you can see how Oracle is going to get that money from OpenAI, right? If they reduce revenue share, they increase their money coming in, they will be able to pay Oracle for that AI infrastructure. So a lot of great information here. If you guys enjoyed today's episode, like I said, make sure to hit the thumbs up, the subscribe button. If not, let me know what you did not like. But this is the best place you're going to get AI news for free. Take care, have a good day, and see you all next time.